Welcome to Stock Talk. We're diving straight into Under Armour today, specifically their latest results, Q4 and the full fiscal year 2025, which they released back on May 13th.
That's right.
We're using their own earnings release as our guide here. And the mission, really, is to pull out the key takeaways. See how these numbers fit into their big strategic reset that's underway.
Okay, let's get into it. So the immediate thing that jumps out is revenue. It's facing challenges. Q4 revenue was down 11%, came in at $1.2 billion.
Okay.
And for the full year, it was down 9%, landing at $5.2 billion.
Yeah.
So yeah, those headwinds they've been talking about, they're definitely still blowing.
Right, persistent headwinds. But here's the interesting part, I think. Even with sales down, their gross margin actually went up. Quite a bit, actually. Up 170 basis points in Q4 to 46.7%.
Yeah.
And even better for the full year, up 180 basis points to 47.9%.
Yeah.
So how are they pulling that off when revenue is falling?
Well, it seems to be about efficiency gains. The report points pretty clearly to better supply chain performance.
Okay.
So think lower costs there. And crucially, they've also pulled back on promotions.
Right. Fewer discounts.
Exactly. Especially online, it seems. So fewer sales, maybe, but the sales they are making are more profitable per item. It looks like a deliberate shift.
Prioritizing margin over just volume. That makes sense.
Yeah.
Okay. But then you look at the bottom line, the actual profit, and it's not there yet.
No.
Q4 shows a $72 million operating loss, $67 million net loss, and it's worse for the full year. How does that square with the better margins?
That's where the strategic reset comes back in. Those losses are partly because they're spending money on the transformation.
Investing in the changes.
Right. The report mentions restructuring charges, other transformation costs. It's like short-term pain for hopefully long-term gain, right? They're spending now to fix things.
Got it. So let's recap those key Q4 numbers quickly. Revenue, $1.2 billion, down 11%.
Yeah.
Gross margin, 46.7%, up 170 basis points. That's the positive highlight. But then operating income, negative $72 million.
Yeah.
Net income, negative $67 million.
Yeah.
So profitability took a step back from last year.
Correct.
One other number that looks maybe positive, inventory, down 1% year over year to $946 million. Seems like good management there.
Absolutely. Keeping inventory tight when sales are down is really critical.
Stops them getting stuck with old stock.
Exactly. Stops them having to discount it heavily later on, which would just eat into those margins they've worked to improve.
Okay, good point. Now, how did things look geographically? Yeah. North America is their biggest market, right? Down 11% there too. That seems significant.
It is significant. The report blames a tough retail environment generally, but also their own distribution changes. What's interesting, though, is even with that revenue drop, North America actually made money $100 million in operating income for Q4.
Oh, wow. Okay.
Yeah, but the margin did shrink there. Still, it shows the scale they have in that region.
Right. What about EMEA, Europe, Middle East, Africa? That looked more resilient.
Much more. Down only 2% on reported revenue, but basically flat if you adjust for currency changes.
Flat. Okay. That's not bad in this climate.
Not bad at all. It suggests maybe the brand or the products are connecting better there, perhaps something to learn from.
Maybe. Though the report did say margins were under pressure there too, even with stable sales.
True. A bit of pressure there.
Now, Asia Pacific, that looked rough. A big drop.
Yeah, that was pretty stark. Down 27%. Or 26% currency neutral, mainly points to China and just general softness across the region.
And profits hit there as well?
Yes. Margins decline there too. That APAC performance is definitely a worry spot, considering the growth potential everyone sees in that region.
You need APAC firing on all cylinders eventually.
Absolutely.
And Latin America. Kind of a mixed signal there.
A bit, yeah. Revenue reported down 10%, but if you strip out the currency impact, it actually grew 3%.
Oh, interesting. So currency really hurt them there.
Massively. But that underlying growth, the 3%, suggests that the business itself might be doing okay there. And they actually improved margins in LATAM too.
Okay, so some positive signs hidden by exchange rates.
Seems like it.
All right, let's switch gears to the products themselves. What's selling, or not selling? Apparel first, their core.
Apparel was down 11%. Pretty broad weakness, it sounds like.
And footwear. That looked like a really tough spot.
Yeah, footwear took a big hit. Down 17%. That really highlights the competitive pressure in that market, I think.
Definitely. But accessories, that was the one bright spot.
Kind of surprising, right? Accessories actually grew 2%, apparently driven by bags and headwear.
Bags and hats.
So yeah, a very mixed picture across the product lines.
It really is. Okay, how are they selling this stuff? Channels? Wholesale first.
Wholesale was down 10%. The report suggests retailers are just being cautious, ordering less.
Understandable. And direct-to-consumer, their own stores and a website.
That channel actually fell more sharply, down 15% overall.
15, wow. How did that break down?
Well, their physical store revenue was down 6%, but e-commerce,
Yeah.
that plunged 27%.
27% online.
Yeah.
In this day and age. That sounds bad.
It sounds bad, but you have to connect it back to what we said earlier about promotions.
Ah, the strategic pullback.
Exactly.
Yeah.
The report directly links that e-com drop to them cutting back on online discounts. They're choosing margin health over online sales volume, it seems.
So it's a deliberate hit to sales figures in that channel.
That's how they frame it, a strategic trade-off.
Okay, and licensing revenue.
Also down by 15%. So yeah, finding top-line growth is clearly the major challenge right now, pretty much everywhere you look.
It really seems that way. Let's talk about fixing things then, the restructuring.
Yeah.
They announced that big plan, $140, $160 million back in May 2024. How's that going?
Well, they've booked some significant costs already, about $58 million in restructuring and impairment charges, plus another $31 million they're calling transformational expenses.
So the spending is happening.
Yes, and CEO Kevin Plank has laid out the priorities pretty clearly.
Right. What are those again?
It's about elevating the product, telling a better brand story, fixing distribution, moving to what they call a category-led model.
Meaning like organizing around running or training, that kind of thing.
Exactly, rather than just channels. And, of course, improving the cost structure overall. That whole package is really the core of their turnaround effort.
Sounds like a deep overhaul, not just tinkering.
Seems that way.
And they're still buying back shares, too.
Yep, another $25 million worth in Q4. Brings the total for the year to $90 million repurchased.
Interesting. And management actually said they thought FY25 result ended up better than they expected a year ago.
Yeah, that was a noteworthy comment.
Despite all the red ink and falling revenue.
Right. It suggests that, internally at least, they feel the progress on the strategic stuff, the cost-cutting, the margin work, the restructuring is maybe ahead of their own schedule, even if the top line isn't there yet. A sign of confidence in the plan, perhaps.
Okay, that's important context. Now, looking forward, they gave guidance for Q1 of the new fiscal year, FY26. What's the outlook?
They're expecting revenue to still be down, but less steeply, down about 4 or 5% overall for Q1.
Okay, so the decline is moderating.
Hopefully. North America is forecast basically in line with that, down 4 or 5%.
Still tough there.
But EMEA, remember how resilient it was? They're actually forecasting high single-digit growth there for Q1.
Oh, that's a genuine bright spot.
It really is a positive sign for that region. Asia-Pacific, though, still expected to struggle. They're guiding for a mid-teen percentage decline.
So that APAC problem isn't fixed yet.
No, clearly still a major focus area. That regional split in the forecast is quite revealing, isn't it?
It really shows where the momentum is and isn't. What about margins and profit for Q1?
They expect gross margin to keep improving, another 40 to 60 basis points up.
Good, continuing the positive trend there.
Yep. And SG&A expenses, selling, general admin costs, they expect those to be down significantly, partly because of lapping a legal settlement from last year, but adjusted SG&A should still leverage slightly.
Meaning costs growing slower than sales or falling faster?
Essentially, yes. Getting more efficient. And because of that, they expect to get back to operating income in Q1.
Back of the black.
Well, $15 million reported, but on an adjusted basis, $30 million operating income.
Okay, adjusted profit.
And adjusted earnings per share around break even, maybe slightly positive, 0.01 to 0.13 cents. They do add a note of caution about potential tariff impacts, though.
Right, always an external risk. So Q1 looking like a step towards stabilization, maybe? At least on the cost and margin side?
That seems to be the hope, that the cost management and margin work starts to really show up on the bottom line, even if adjusted.
Okay. And finally, how does the company itself frame the situation, the opportunities and risks they see?
They lay it out pretty clearly. Opportunities, keep expanding gross margin, make that category-led model work, build on the growth in EMA and accessories, and reposition the brand effectively.
Makes sense. And the risks?
Pretty much the flip side. Continued revenue declines overall, the ongoing weakness in Asia-Pacific and footwear, those potential tariff impacts, and just the basic risk of executing this big restructuring successfully. It's a lot to manage.
It is. It's a balanced view, acknowledging both the potential and the hurdles.
Yeah.
So if we pull this all together, Under Armour is very clearly a company in transition, deep in it.
No doubt about it.
Revenue is going the wrong way, quite significantly in some areas. That's the big challenge.
The top-line pressure is undeniable.
But offsetting that, at least partially, is real progress on profitability per sale, those gross margins, and getting leaner, more efficient operationally. Better inventory control, too.
Exactly. You've got these two opposing trends, really. Falling sales, but improving underlying profitability metrics and cost structure.
And that Q1 forecast suggests maybe, just maybe, things are starting to stabilize a bit with a slower rate of decline and that return to adjusted profit.
It hints at a potential inflection point, yes, but it's early days for the new fiscal year.
So the big question hanging over everything as they continue this transformation is really, can they translate these efficiency gains, these better margins, into getting the top line growing again, sustainably?
That's the multi-billion-dollar question, isn't it?
What's it going to take for them to really click with consumers again in such a crowded, competitive market?
Yeah.
You know, watching those regional trends, especially EMEA versus APAC, and seeing if footwear can recover.
Yeah.
Those seem like key things to track going forward.
Absolutely. Those will be the indicators of whether the strategic reset can ultimately deliver both profit and growth.